35 or 40% of the S&P 500 and the NASDAQ is tied directly to these kind of mega cap AI semi-chip names. And so even if you're like, well, I'm in the S&P 500, you're actually just basically in the AI trade. You can make that case very strongly in either direction, because even though we're selling off, vol's not over expensive right now. Like, people aren't terribly piled into puts. That's why we focus so much on this Nvidia earnings, because narratives aside, I don't really care. Are people hedging that event? Are guys like Citadel or Optiver or whatever, like quant smart, incredibly smart people, are they worried about that event? And if they're worried about it, then it tells me it's important. It's hard to read this and say, hey, vol's too expensive, or hey, vol's obviously too cheap. It's really right in that middle spot where, this is where things break, but also there's a decent premium you could sell to help jack the market up. So, it's a weird, again, it's a weird situation.
So Brent, can we say volatility is back? I don't know. Like I feel like it might be back.
It is back. I'm laughing because I think that's for the last month we had like incredible vol. It's like, oh my God. And the next day it's like fine. Then the next, 2 weeks later, but this seems different. We were just talking about this. Like things are weird. Like
Is it possible? Like I was looking right before we got on and I did the calculation quick. Is it possible like the S&P is only a few percent off the highs? Is that right? I mean, I feel like it should be a lot more than that, but then when I look at the numbers, it's like, it's not that much.
Yeah, there's nothing but straight facts coming from you today, Jack. It's like, it's like 3% from all-time highs. I mean, we were within 2% of 7,000 yesterday. We were sniffing that level, and then, we took the slide lower. It feels, this is like a statement about the world, and I was saying this, Jack, before, like, I don't want to, there's certain things or certain terms or topics that I don't want to broach here because I don't want to deal with like the hate mail, even though we say send hate mail to you. But
I'd love to receive it.
Things feel really just kind of gross right now across everything, but the market's only like, I don't know, sniffing of all-time high. But it feels really bad. I don't know. Can I talk about my feelings in this?
Yeah. We can talk about feelings on here. It's a therapy session if you want it to be. But you're right. It is.
I feel sad, Jack. Yeah.
And we've probably talked about this a lot. Like there's just a lot of weird stuff going on. I mean, obviously, like to your point, in real life, there's a lot of weird stuff going on, but there's weird stuff going on in the markets too. And, and some of it, and maybe I think from what you told me before, we won't be able to explain all of it this time, but some of it can be explained by options, but some of it can't be explained by options. It's just an interesting dynamic in the market, I would say right now.
Right. And I think one of the best ways to lose 75% of the viewers is to say that this is not about options right now.
Right.
But as someone who is constantly pounding the table, like options are doing this, options are doing this, options are doing this. I'm sitting here thinking like, man, I don't know. This is a non-options event in some ways. There is a lot of interesting data that we could still look at here. And I think for the macro viewers out there and more fundamental viewers out there, you're going to be able to pull some things from this. But this is part of the weirdness, right? The fact that like Tesla, for example, Tesla's down like what 12% over the last 2 days or whatever, and it's like no one's buying puts. There's just this puking, which I have a concern that is a lot more credit related maybe than and bond related than or rate related, I should say, than some other things. So there's just a lot of uncertainty here, and I think what you end up with is an icky feeling, right? Because everything is uncertain, and to this point, you're talking about like CPI. You can't even get a CPI data printout, so you can't even parse through what's going on. If you wanted to, I guess.
And what's interesting too is like it's like there's still some degree of speculative behavior going on, definitely, like probably a good amount of speculative behavior, but some other stuff has been like completely destroyed. Like on the speculative behavior point, it was interesting. Like there's this stock, I don't own it, but there was this stock I tracked that was like a biotech. It was like, it was in the less than $1 range because whatever their trials didn't work out and they thought maybe there'd be some future trials that would work out. But like this week, the biotech converted to a Zcash crypto, whatever you call it, treasury company. And it went from like, it was up like 500% on that day. So like this random biotech stock becomes like a crypto treasury company. And like the Winklevoss twins got involved or something. And I'm like, what the gosh. I was looking at it like on the chart, like what the hell just happened? And that's what it was. So like, there's still that kind of stuff going on, which kind of brings you back to the .com era when anything added .com to their name, like it went up. But by the same token, like other stuff is getting destroyed right now. So I don't know. It's just a really weird market.
I think you highlight one of the core features of this market, just general asset regime is just the financialization of everything, levered ETF, crypto, speculation, and a lot of it feels like grift at the end. Like it's not about the stability of the system. It's sort of like, how can we just make some money out of nothing, dash for cash or whatever. It's just it's odd, man. And that's so funny. And when you think, what made me laugh about that is like, if you're going to write a book, right. And you were going to, your kid would read the book in 5 years and look back and be like, wait, you guys did that? Like that is so obviously a bunch of, BS. Like, of course it was a signal that, this whole thing is is a house of cards. You'd be like, well, yeah, of course it is. But in the moment, you're like, well, how can I, what grift do I have to play next to, try to keep up with the market? You know what I'm saying? It's like this.
This is the stuff that, like, when we look back at the .com thing from 2000, some of that stuff is like, obviously, this was a huge problem.
Yeah.
That's a great example of the same thing. We're going to eventually look back and be like,
yeah, the housing market giving money to, whomever was looking for a loan, and here's unlimited loan. Like, what do you do for a living? Oh, you don't have any actually recorded income. Great. Here's $1 million mortgage,
But the problem is, we could just as easily be in 1996 as we are in 1999 right now. And that's the challenge of it, is like, you will look back in retrospect and be like, this stuff was crazy, but you don't know when you're going to do it. Like, and it could go on for years before we eventually do that.
Yeah. And it feels just as bad to see the market run away from you, or an asset run away from you, and here on X or whatever, that like, I made $1 million today on this biotech stock that went to crypto. It hurts a little to miss that. So
yeah. And I mean, like, to me, I'm like, oh, I should have bought that biotech stock, but I really had no reason whatsoever to buy that biotech stock. And if I did have a reason, it certainly wouldn't be because I thought it was going to convert into a crypto treasury company and go up 300%. So it would have been complete luck if it like worked out for me. So I can't really look back and like say it was a mistake, because I was just following it. There was no basis to do anything with it.
Yeah. And as a value investor, you're pretty used to the pain of seeing stocks just run away from you.
I am. Yeah. It's my retailers in the mall or whatever are not doing that. Maybe they'll convert into crypto treasury companies, though. Maybe the value stocks will start converting to crypto treasury companies, and that will be the key to values. Like resurgence will be complete conversion to crypto treasury companies.
When we have a deflationary collapse, the value stocks may be all that's left, and then we can change this podcast to the value effect. And then
we'll flip things around. You'll interview me about my value investing. I like that. Right. So people have probably heard enough from us on this now, so we probably should get into the option stuff.
Yes, now that everyone's
and
gone.
By the way, I like the Star Wars. The Star Wars is great this time.
I was trying to jazz things up, in this age of short attention spans and everything. Now we've blabbed for 20 minutes or whatever it is on nonsense. We had the K-pop Vol Hunters before. I don't remember what I did the last episode or the last slide, but this one is the famous scene, if you're listening to this, of Princess Leia, and she's asking Obi-Wan Kenobi for help. And I can't find a better parallel than Nvidia earnings coming up on Wednesday and us saying, hey, Jensen, you are the only one that can save us. And I honestly think there's a ton of truth in that. I say it kind of tongue in cheek. But that's kind of what it feels like. If there is one last hope, it is that Nvidia can save us all from certain collapse.
Yes, I guess it's not out of the question that they will. I mean, Nvidia's delivered a lot of these times when the markets kind of needed their earnings.
Yeah, and there's a lot of narratives, right, that are folding right now, and unlimited chip sales or GPU sales or whatever it is can maybe turn the tide back in favor. And on that point, last month in October, we were joking about the fact that, kind of like the crypto thing, if you mentioned OpenAI for any reason, your stock just leapt. Like, it just like PayPal mentioned OpenAI, and like, hey, I did a deal with OpenAI for this or that, and the stocks would just go crazy, right? And it was sort of this sign of ridiculousness. But the reason I kept, and this was the slide I used last time, the picture on the left, is because, man, how fast the story changed in the matter of just like a week or two, right? Like, all of a sudden we went from AI is everything, and there was these pictures going around of the kind of like Nvidia in the middle and OpenAI in the middle of this sort of debt kind of circle or triangle. Are you familiar with that
yes.
chart that was going around?
Yes.
And all I could think of from this, have you ever seen Silicon Valley? Did you watch that show?
I didn't know.
Okay, you won't understand this, but they designed this software called Middle Out, and that's all I could think about. And it's a little too, if you know what I'm talking about, you know what I'm talking about. Jackie, don't, so I'll stop and move on because it's also not PC. But the point is that there was this narrative all of a sudden that just shifted from, like unlimited AI growth to, this was the headline about the United States has to bail out these AI companies or whatever. And you're like, wait, what are you talking about? How could this be possible? And then you start to see this now, like Oracle, which was sort of just about a month ago, the poster child of AI success and TikTok and all this stuff. And now their credit default swaps are really surging, as are some of these other names. And, that narrative shifting and that unease and that uncertainty just kind of, I don't want to say it came out of nowhere, but it's just like the sentiment just changed on a dime. And that's kind of what we're dealing with right now. And that's why we need Jensen Huang to sort of say like, okay, it's all right, everybody. Like the growth story is still here and make us believers again.
Yeah, it kind of reminds me of DeepSeek. Like at the same, like in DeepSeek, we just got over it, we moved on. But like the question is, will we this time? We just did an episode with Kai Wu on this. It's really interesting. Like if you look at this AI capex spend and you kind of look at it relative to history, and you say like, did it work out in other periods? The railroads or the internet, and there's just a lot of interesting conclusions from that. And it seems like the market is starting to think more hard about like, is all this money actually worth it?
Yeah. And I think there was another Chinese model that recently came out that was trained for, a lot less than expected. So you look at the free cash flow of the Mag 7 names and the AI names, and the story is really just changed. Like that free cash flow is going away, and then people are like, well, we're going to have buybacks now because of the free cash flow story. So again, it's a real transition sentiment transition, right? That we're going through right now. And as this relates to options, it's interesting because again, we usually talk about the fact, or I talk about the fact that like options are doing this and options are doing that and options are doing the other thing. Look. In this one, there's not a lot of options flows that are supportive of kind of how violent some of these single stocks have come down, which to me tells me that there is a push for people to try to sell their stock and sell their investments, right? They're starting to liquidate and pull away. And it was interesting because I started to put this slide deck together, and then Charlie McGilligan put out his mirror note, and it echoed some of that. He says it in a much more eloquent fashion, but I was happy because I was like feeling weird about the data, and like sort of it screams that some other things are going on. And he put it sort of nicely. It's sort of like a race to get out first, right? Like if you've been long AI stocks in this period and suddenly the narrative is shifting, then you got to quickly sell because you may be up 40-50% in some of these names, but you just lost 10% in the last day. So that doesn't feel well if indeed the top is in. So again, transitory period here.
Yeah, it's the idea though. It's the idea is like real selling might be a little bit more predictive of the future than if everybody's buying puts. Like there might be more of a chance of reversal if everybody's buying puts versus if there's actual legitimate real selling behind the scenes.
Well, I think that it speaks to like the sentiment change. Like the real money selling is a sign that, you think about the tailwind of stocks, and there's just been this tailwind for the last 5 years of every dip is bought. AI is going to continue to succeed. It's the driver of economic growth here, and investors were just happy to kind of ride that out, right? And so you would get a lot of kind of volatility around the trend higher. And I think that's where the options market would step in, right? We get overbought and then we moved a little oversold, but the trend would still be higher. And I think the concern here would be, look, the AI story, the foundation that all of this is built on, seems to be sort of crumbling, or the picture is just not the same. And so you lose that tailwind of, the trend higher. And I think to me, that's really what the problem is. Doesn't mean we can't have a crazy short covering rally here, but if you don't have like the fundamental real money buyers, moving into these names, what is the growth story, right? And so the idea of buying dips and selling every little vol pop as a source of alpha may change if you lose that sort of fundamental buyer. I think that's the thing that everyone has to think about into Nvidia earnings and kind of into the end of this year as we look towards understanding if all this capex is warranted.
Yeah, just as we get to this chart, like you probably saw Michael Sembalest's data on this. I mean, everything about the market has been AI. Like the earnings growth is AI, the cash flow is AI, the performance is AI. And like we had Bob Elliott on yesterday, and he was talking about this idea that like, if you look at the S&P 500 equal weight is kind of a measure of like the economy, like that's not doing much of anything because the economy is kind of just like trudging along here, not doing much of anything. And that's sort of what your average, stock is doing as well. It's like AI has been the entire thing that's held us up. So to your point, as we get into this next chart about Nvidia's impact, like it's really, really important when that is the trade that's driving the market.
Yes, 35 or 40% of the S&P 500 and the NASDAQ is tied directly to these kind of mega cap AI semi-chip names. And so even if you're like, well, I'm in the S&P 500, you're actually just basically in the AI trade. Like that's all that is. And I don't know how much like the average investor thinks about that. Like if you are just sort of like passively investing in your 401k every month because you work at whatever, some corporation, you don't maybe understand that like you are basically just long the AI trade like everybody else. And that's worked out really well, and maybe it continues to work out, and maybe we all should hope it does, because that is the only real growth driver in the US right now. And then you start to think about just this idea that like we have to build like the agentic, AI or whatever first before every other country. And so there's like this weird, national security issues. Like it's a complicated web to weave. And so you wonder like, okay, if AI starts to falter, do you just get like cash injected from, like the government? It's like, I know I'm going like way off topic here, but it is this like growth story. And it feels like, I guess what is different about it is like like the US economy arguably wasn't dependent on pets.com in the 2000 being, the main growth driver. I don't think in the same way that we're just very dependent, uh, almost to a fundamental perspective on AI here now. So again, we've strayed completely off topic here. And we've lost, I think, 90% of the audience.
Well, the commenters will let us know if we got too far here. But as
there's
we
always
shift
one
into
guy.
options,
He's like, Brent, get back in your lane. This guy Don.
this is an interesting chart here in terms of like Nvidia's impact on volatility in the S&P 500.
Yeah. So what this is forward implied vol, and forward implied vol is essentially a way of just modeling what the volatility is between expirations. And so the fact that you see this big jump, right, but for Nvidia's earnings date, specifically Nvidia reports the night of 11/19, and so the implied volatility for the Nvidia earnings is between the expiration between the 19th and the 20th. That makes sense. So we look at what the implied vol is between those two expiration dates, and it's extremely elevated for the S&P. That's quite unusual in relation to a single stock earnings. You don't really see that with any other single stock earnings, and this really just speaks to the fact that there's this vol spike here, really just speaks to the fact that the market is really dependent on this earnings event to keep this narrative intact. Now, on the same day, we have VIX expiration, which is going to be more important as the VIX spikes higher. And then obviously we have OPEX on the following Friday. So there's this cluster of events that's critically important. And then, Jack, this is going to come up later, but if you look to the right, you see how that forward implied vol is below the term structure. So this is the S&P term structure, which is the S&P vol. So we go from above to below. Why are we below? Because we have Thanksgiving, right? So you go into Thanksgiving and you have the holiday and a half day. And so generally vol is sold into those periods, right? And so the sort of the time series here, or the path dependency of the way that things play out, matter given the fact that we have Nvidia earnings, OPEX, and then a holiday, right? That really can craft the response in the market movement, I think, over the next month, which is critical here into year end. And so as we get back on our track here, I hope that people will take away the importance of the timing of these events.
Yeah, and our first section of charts here are all about why options are so important. And so this first one is, and I think I just saw Chris Sidiel just tweeted something, like some more stats about how crazy options volume is. I should have brought him up here, but like it's anything you look at is like options volume is grown dramatically, and it continues to grow.
Yeah, exactly. And the argument here is that the options volume is outpacing stock volume. You make the argument that stock volume is going to increase because of hedging flows related to options. And so, this is just sort of the financialization of everything as people move into some of these products like options. And, we love options trading here, so I hope this trend continues. But you can get incredible risk reward, sensible risk reward using options trade. So it makes sense. It's not all about, sort of leverage and gross egregious speculation. Like there's a lot of great reasons to trade options, and, that's being adopted in a lot of ways, new entrants to the market and more sophisticated retail trading. And I know the chart you're talking about with that Chris had posted. I think it's a Goldman chart that just basically says, monthly options volume hit another record in October, essentially. So the volumes keep growing. The basic idea here is,
by the way, just about that is, it said in there that retail volume is now larger than institutional volume in options. I didn't know that. If that's true, that's pretty crazy.
Yeah. I don't, I think they extrapolate some of that from some of the brokerage data out there. There's some reporting from Robinhoods and things like that. I think some of it also gets a little skewed maybe because what you do see is an increase in algo trading. So I think there's more small lot trading out there than there used to be. So I'm not completely sold on this idea that it's retail over institutions at this point. But I do think retail options, volumes are growing. I mean, we see a lot of retail community come into spot gamma. So I do believe that is true. But I'm not yet sold on the idea that that retail is bigger than institutions. To that point, if you go to our Twitter or X handle, you can see there's a ton of trading yesterday in Tesla, for example. Someone was just selling essentially about $2-3 billion worth, $2 billion worth of deltas, right? And they did that in one lot options over the course of the day. So they just put it in algo and basically just like percentage of volume that trade over the whole course of the day, where it's just like sell one lot, sell one lot, sell one lot, just in an algo again the whole entire day. And so those shows up as one lots tagged as a customer order. And, is that really deciphered as a retail trade because it's a one lot, whereas we know it's part of a much bigger trade, right? This what ended up being about 100,000 contracts. So that's the type of flow that I think can be maybe mislabeled or misallocated sometimes.
So this next slide gets this idea, whether it's retail or institutional, when people are buying these options, hedging flows get triggered and the whole process goes on behind the scenes.
Yeah, and the point here is that a lot of small orders can add up to be a lot of exposure for a market maker. Market makers are 90% of the U.S. volume, so the liquidity provider for 90% of the volume. So in this case, you have a bunch of individual traders putting in orders for AMC calls. Basic options at the money option has what's called a 50 delta, which means that to hedge, you need 50 shares of stock per options traded. So if 100,000 calls trade either from one entity or a bunch of retail guys putting orders in, that can be as many as, in this case, 5 million shares to buy of AMC. And if that's a rapid fire order in a fast market, the argument is that trading from the market makers, that hedging has to happen now, right? They don't have the luxury of waiting. So you can imagine in that case, 5 million shares, that's a lot of stock. So that is the driver, or that's the transmission mechanism from options trades into the impact of the underlying stock. And then, of course, these trades have to be, or the hedge flows have to be adjusted. So here's just the delta we were talking about before, but the delta changes as the stock moves, right? So that's called gamma. You have to adjust those shares, buying and selling to keep yourself hedged. The delta or the hedge ratio, that's those 5 million shares, would also change as implied volatility shifts up and down. So in a market where VIX is at 30 and then goes to 10, that's a signal of implied vol changing. As an example, hedging flows have to change because of that. And then lastly, of course, is time. As we get closer to expiration, that makes you adjust those deltas again. So you start with 5 million shares, but through time passing and implied vol moving around and the stock moving up and down, you have to adjust those hedging flows constantly, right? Which is the flows that we monitor here to assess those impacts.
And this next slide gets to why we're here today, which is this is going to come out on November 15th. The following Friday will be options expiration. And in many ways, that expiration is both the beginning and the end of a cycle.
That's right. So on the third Friday of the month tends to be when the bulk of options positions expire. And then we'll start focusing on December. There are a lot of December positions, but as we get closer to December, more trades get tied to that expiration. And then the hedges associated with those positions build up. And then also when we kind of crescendo at expiration, all these positions get wiped out. All the hedges have to get unwound, and then we sort of start a new cycle. And there's evidence that there is price and volatility impact in these cycles. In fact, this time what we see is that 2/3 of the time, S&P performance flips after OPEX. So if the market is rallying into OPEX, it sells off after, and vice versa. Now, what's interesting here is that this has some dependency whether VIX expiration occurs before or after OPEX. In this case, VIX expiration falls before. So you can see the odds slip a little bit there of that price flip, but it's still better than 50-50 that you get a price flip. And of course, this data doesn't necessarily extrapolate when expirations were really large, like a quarterly expiration versus say a smaller monthly expiration. And for all intents and purposes, this is a little bit of a smaller options expiration. We talk about also the change in implied vol. And what this is showing you here is that when you have high realized volatility into an expiration, so this is the change in realized vol tends to contract into expiration and then expand out, right? So what that essentially means is stocks tend to get penny into an expiration and then release, or volatility releases out of an expiration. Now, what's interesting about this is that you can also see in data that if vol is spiking into an expiration, vol mean reverts or sells off or contracts after an expiration. So that mean reversion factor seems to also exist in volatility as it does in stock prices.
And as we look at this next chart, I mean, we're as far to the left as we've been in a while, right? In terms of volatility.
Yeah, exactly. And so what this is measuring is how much gamma do we have in the S&P on the x-axis, and then the y is 1 day forward volatility. And so there's a really an amazing correlation between these two. And the point here is that options positions as a driver of volatility exist in this short-term period, right? And so we're all the way to the left where gamma is quite negative, and that is a driver of volatility. Now, the argument is that if options positions are removed, right, then gamma should reduce, right? Because if negative gamma is driven from put buyers, for example, and puts expire, well, that gamma should go away and then volatility should reduce. So that syncs up with this data here that shows that volatility tends to mean revert. So, we're in this position where gamma is a driver of volatility. I don't think it is the cause of volatility here. Sometimes I do think it is, like if you look at earlier in October, some of those spasms. But here it is an additive or a sort of a turbocharger on volatility as opposed to the underlying cause.
So in this next slide, we're looking at some of these events we've been through and some that are also coming up as well.
Yeah, so we mentioned before about the interesting spasm that we had in October 10th, right, when Trump tweeted and the market broke, right, and there were such bizarre call skews or heavy call skews into that period. So when I was talking about options as a cause of volatility, I fully believe that was October 10th, and even a little bit later into the end of November when we had that volatility. It was kind of a similar thing where we had kind of a similar spasm, right? But we're ending up here, as you can see, the market is having a pretty decent drawdown. I mean, it was only 2 weeks ago, though, we had a much sharper S&P price drawdown, right? So even though this feels really bad right now and it feels gross, S&P is not doing all that bad, right? But the point here and the key here is that we're going to move into this period, right, where there's a huge Nvidia earnings along with the big VIX expiration in November OPEX. So if you see a scenario where the market just pukes into that VIX expiration removes a lot of expensive VIX calls. People roll their positions. It reduces hedging flows. And then maybe Nvidia earnings are great. And then suddenly you could see just a ridiculous rally off of just the flows of that volatility sort of being sold, right? And obviously OPEX, coincides with that as well. So the weird one's going to be is if Nvidia misses or reinforces this idea that markets are that the AI story is indeed sort of done, right? Then that is a much harder to parse situation here. So we're going to talk about that. But the fact that vol's getting breaking out here into an expiration, I think is good for bulls, assuming that the Nvidia data is good, because I think that ultimately this could be a real slingshot opportunity if Nvidia earnings are okay.
Yeah, looking at the behind the scenes data on this expiration, I mean, I think this is, and you have it in the title here, put-skewed. This seems to be the most put-skewed we've had in a while.
Yeah, if you think about recent presentations where we're getting 80-90% of the value of options were in calls, right? This is a total state change from that. And the fact that when you're looking at the index positions, which is NASDAQ and Russell, for example, those are very weighted towards puts. Same thing in the ETFs. And in single stocks to have only 60% in calls is actually very skewed, right? Normally you're in the 90%. So this is indeed a put-heavy expiration. And it's not a massive expiration. Here's the delta value by expiration. So here you see the next week's expiration. It's dwarf, it's only about a third of the size of December expiration. So this is not a massively pivotal expiration at this moment. If stocks continue to obviously decline and vol continues to spike, then the November importance kind of picks up. However, I think that this expiration is somewhat supercharged by the fact, again, that the VIX complex is more active at the moment. VIX, as we're talking, is right around 20 to 25, somewhere in that neighborhood. And then obviously the Nvidia earnings, right? So, you have the situation where normally you'd be like, this is a decent expiration, not all that big of a deal, towards this is a much bigger situation, given the earnings, given the market drawdown.
Back to the previous slide, is there anything to read into this idea that the S&P is the most call heavy, and as we work our way down, it becomes more put heavy?
It's a weird factor, I would say. And what I would read into this is that yesterday, only yesterday, we were above 6,800 and we were very close to all-time highs, right? We were only maybe 50 bips off of all-time highs on a closing basis. So I think that people were caught quite flat-footed by yesterday's selling, and we broke this 6,800 level, which was, and look, we were leaning, I had a bullish leaning into yesterday, and our risk pivot, we call it, was 6,800, meaning under 6,800, things can get ugly. And I didn't expect us to cross that. We did. And once we crossed that level, it was just this vacuum, right? Now, futures are rallying back pretty sharply right now. In fact, we're unchanged after being down 1%. So The reason I think calls are not more heavily weighted is simply because of the fact that the market wasn't positioned for that. And so I would expect this data, which is based on last night's close, Thursday night's close, to change, obviously today. But you do bring up this point where oftentimes we're 80%, like we're very heavily, skewed towards calls. And then there's a much bigger kind of response when there's a sell-off because of the fact that everyone is like over their skis on the call side. And you don't get that at this moment, right? It doesn't really feel like that at this moment, which again is a reason that it's hard to pin options as a major driver of what's happening yesterday and today.
So I'd assume on the next slide, December will probably be the largest ever. I would guess. Largest
Probably.
expiration
I
ever?
mean, the options market just continues to grow, and December is always the biggest options expiration. So, there's a huge expiration coming up. Big FOMC with a lot of uncertainty. If we do rally again, that's only going to drive call values even higher. So, there's the potential for this to be the biggest expiration ever. It's going to be a very interesting year end. I think more so than usual, given the rate uncertainty in the AI story. So, long way to go before December OPEX, but quite potentially the biggest expiration ever.
So before we look at the current expiration, we always like to look back at what we've looked at in the previous thing and see what was right and what was wrong.
Yeah.
What do you see here?
And I like to celebrate what I got right and ignore what I got wrong. So we'll try to focus on that here. But we're talking about the concentration of stocks. We just started this conversation off with our diatribe about that. 38% in the top S&P, and we were trying to describe why the October 10th spasm was just so volatility or options driven, and call volumes, as you can see here, went bananas. People were just piling into the trades we all have been discussing here. Correlation, which is a metric that we watch for risk, such a key metric for risk. It just kind of sums up, whereas it distills all the things that can go wrong when people get too piled into single stock calls. That hit our lows for risk off. You can see here the 10-10 spasm, the result of that crazy positioning we had, just records in terms of how fast we went from total calm to complete panic, right, in the course of just a day, right? And so when you think about this sell-off here, where the options market wasn't that oddly positioned, and we're selling off, but it's not that, and the index side is not that violent. There's some single stock violence, but we're not positioned for a crazy unwind. It kind of pushes more to this idea that there's something fundamental going on in terms of fundamental sellers maybe stepping up in a way they haven't, right? So, that's a key thing here. Again, looking at the realized vol, the position from risk on to risk off is also an interesting one here, right? Because this trail shows us the 10-day of history, and you saw all these names that were on the right side of this chart, SMH, Google, SMH, Spider, Qs, et cetera, went from, hey, we love calls to we all need puts, right? And that was this thing that happened very quickly. We're going to touch on a similar idea here shortly. The reset of implied vol from really low to sort of moderating. So you think about what October was, and it was this resetting of, we were way too bullish, calls were way too bid, and then we sort of had this spasm and things reset. If you remember that too, then the market kind of retrenched, right? Here's the spasm where we were talking about October OPEX. OPEX hits, it clears out all these positions, and then you can see there we go. There's the rally, right? Sell off into OPEX, and we rally out of that. So, you can see all these pieces really come together in terms of an options market that was screaming overbought, and now, and then moderated after, right?
And that tail risk both sides thing is interesting, because we've had macro guests who kind of were looking at it in a completely different way, but say the same thing. It seemed to be this two-tailed market. And it probably still is, I guess. I mean, you can tell me.
Yeah, 100%. And, this is the forward implied vol out of October. And, we had these data points where we had, PCE and Fed. So all those typical data points that add a little bit of vol. But this picture all got screwed up by the government shutdown, right? So, on one perspective, is this is what you're forecasting. Then we get the longest shutdown in government history, which just sort of throws a wrench in all this. But I would note here is the Nvidia earnings, right? Way out here as a key event, right? And that's not me saying it's a key event. That's the market pricing in a lot of volatility around that. And so, that's why we focus so much on this Nvidia earnings, because narratives aside, I don't really care, are people hedging that event? Are guys like Citadel or Optiver or whatever, quant smart, incredibly smart people, are they worried about that event? And if they're worried about it, then it tells me it's important.
Yeah, and it's interesting, on the macro side, you could really make a case for both tails right now. Like I can make a case that, if you think about like in 2000, there was like this Barron's article, I think, that talked about how the internet companies were running out of cash. And that's what some people say was part of what led to the topping process. You could argue, well, that's kind of similar to people are looking at this AI spend now and being like, yeah, is this really going to produce any money? But then on the other side, you could make the case that this is such a transformative technology that we've got years ahead of us. It's just interesting. And this is obviously, you don't think in those kind of longer timeframes with options, but it's just interesting. You've got that two-tailed case on the macro side as well.
Yeah, without a doubt. And when I think about the two-tailed market, just from the shorter term time frames, I can make a very easy case for this market to be at 7,000 and I'm going to make that case, in within a few weeks, right? So you you have a problem if you're short or not invested, because the market in this kind of financialized, system with levered ETFs and options flows and all sorts, you get these incredible reactions where the market just suddenly rips 5% and you're left behind it. 5% is material, right? You don't want to be sitting there in the end of the year saying, "Oh, I sold all my stock and I just missed this rally." Like that doesn't feel good. But at the same time, like, well, geez, where's the defined downside right now? And quite frankly, I just don't see it. And if the options market hasn't woken up yet in terms of buying into hedges, and it does, then you're like, well, man, what is this? Like, we're going to go down another 5 to 10%, right? You can make that case very strongly in either direction, because even though we're selling off, fall's not over expensive right now. Like, people aren't terribly piled into puts, which is my risk indicator. So yeah, you have this really kind of tenuous, again, anxiety feeling around, which way this thing's going to go, because it's sort of like, there's going to be a pain trade, right? And you just want to be on the right side of that pain trade.
As we move into November, it's interesting. This idea no asset is safe, because one of the things we run is like, we run some of these really diversified strategies that are not just stocks and bonds and this other stuff. And one of the things you've noticed recently, and this might get to what you're talking about the chart, is like some of these other things have been selling off too recently.
Yeah.
It hasn't just been, there's been a lot of different other things. So you could talk about what you're saying here.
Yeah, one of the things I do when I'm looking at how markets are performing, and I'm sure a lot of the other traders, investors, listeners do the same thing, is I'll look at the S&P. S&P's weak, and then how are other assets performing? Obviously, right? Is there a correlation? Because I want to be able to describe what's happening in an accurate way, and if there are other assets that are moving in correlation, then I start to worry about things being more of a macro driver than an options market driver. For example, so if Bitcoin is stable and gold is stable and the bond market's not really doing anything, but vol's freaking out, and I know the options positions are all out of whack, then I feel better about identifying options as the primary driver. Now, in this case, I was honestly pretty surprised to look at gold this morning, and it's down 2%. And it was breaking out, and it was looking so strong earlier this week. And you think to yourself, well, if the story here is the concern about uncertainty around the government and the shutdown and we need a safe haven and all these other things, well, why is gold getting pummeled, right? And then when you look at Bitcoin, it's getting pummeled. And you look at the bonds, right? This is the 10-year bond, it's going down as well. So yields are kind of creeping up. And you go, okay, like, clearly there is a macro event happening right now because of the fact that all of these assets are moving in such correlation with each other. And so that's one of the reasons where I will step back a little bit and say, okay, options as a driver here are clearly, they're not in the driver's seat. I think they can exacerbate vol, but I want to be honest and clear-headed about, what is the fundamental driver here? Because if the options market is not big enough to turn things around, right, and this is about rates or credit defaults or whatever it may be, then I don't want to sit here saying, well, OPEX will clear vol out in the market or rally because of that, right? Ultimately, if the credit market breaks, like, it doesn't matter what the options market is doing, right? It's like, it doesn't matter what equities are doing, for example. So the fact that all assets are dropping is just something we have to flag and pay attention to. Like clearly there are, there's some type of a macro spasm is what it seems like.
Yeah, and this next slide is this one of these weird things, which is we haven't had data. Like, you and I have talked about a million CPI reports on here. Like, we're looking forward to the CPI report, and then, like, it's weird when there isn't the CPI report.
Yeah. And, in April, I remember sitting there thinking, like, this is actually, like, normally the market's selling off, and they're kind of like, whatever. Okay, fine. Like, 2022 is like, whatever. April, I was sitting there for a minute, like, this is actually could be one of those times where it's like you start to worry about, like, like, should I close my bank account and put my cash in, in a box in the backyard or something like that. And right now, it just has that feeling of just like, what the heck is going on, man? And so, I just wanted to mark some of these things. I mean, the Trump approval rating, and again, send your hate mail about anything related to this to Jack, jack@jackharris.com, I think is his email.
Well, they'll leave it in the YouTube comments, Brent.
Yeah, and like, look, the ratings are down, right? And the reason I bring this up is simply because I think a lot of the policies and things like that we were expecting out of him, all of a sudden, like, I don't know, it just seems like unclear, right? So fine, there's disapproval, there's anxiety around that, government shutdown, all that stuff. That's uncertainty. It doesn't matter how you feel about it. Things are much more uncertain, I think, there than they were. If you look at rate probabilities, I feel like the economy is not doing that great. You see job losses, or people say that, or I don't know. But now rate probabilities have gone from, we're definitely getting a cut from a week or a month ago to 50-50, right? Well, who likes 50-50? Nobody. So you can't really count on that out of the Fed. We talked about the credit default swaps. Oracle, was the story that everyone knew about. Hey, the credit default swaps there are spiking. And then CoreWeave comes out earlier this week with their earnings, and now their credit default swaps are apparently just, surging. Yeah, Intel and Amazon, some of these other ones are up a little bit. I don't know that it matters quite as much right now, but, this CoreWeave thing really seemed to just sort of like put a stamp on AI as a situation. That stock's been absolutely crushed. You got Sam Altman on this podcast making some weird comments as well about OpenAI and their debt and stuff like that. So it's just, it's just been pretty ugly. And then to top it all off, you go, okay, great. Like, well, let's get the CPI report so we can see how inflation is doing. And they're like, oh, we're not going to give you a CPI, maybe ever. And so then you just go, well, geez, what am I even supposed to do at this point, right? It's just like the uncertainty is compounded by even more uncertainty, and markets understandably don't like that, right? So the manifestation, I guess, of all of this, if you're going to take away the liquidity punch bowl here, and you want to talk about lost narrative, crypto right now, IBIT and ETH are the two big ETFs, and those volumes are consistently top 10, top 15 in the U.S. option space. They've gone away, right? Nobody even cares. And I always laugh about this because when you look at some of these charts, my daughter always likes to make this joke when she walking with something crazy, she was like, bro, and that's kind of like what this is like, what is going on here with crypto? It loses 100. And, when you look at MicroStrategy, and MicroStrategy is just like the sort of manifestation of the crypto bros, like people quitting their job because they just believe that the MicroStrategy yield is just so important. And he financialized himself to death because he was trying to monetize the volatility of MicroStrategy by selling convertible bonds, and then the convertible bonds squash the vol, so he can't sell. It's like, it's just this bananas situation. And you're like, the story says under 185, like they start to have problems, right? And so, this is just like the punching bag, or like the canary in the coal mine, maybe. I'm not entirely sure. But it's interesting because if you talk about loss of a narrative, or sort of like the reflexive buy the dip seems to be broken in the crypto space, and crypto tends to, in my view, lead risk assets, right? If you're going to step out on the risk spectrum, crypto is that. It's a sign of liquidity. Like, if liquidity is not really going to be offered by the Fed, what's going to help prop up Bitcoin? And then I think the other thing too that's important is, how many people were invested in crypto as like the next asset class? And if you talk about struggling economy, people just not feeling good. Again, I'm getting way off of my track here, but you go like, well, if you're already struggling and can't really get a good job or whatever it is, and then your little crypto portfolio blows up, like, that's just more it's just more bad feelings.
My kids are doing the bro thing too, and I have no idea where it comes from. Like, these things just come, like, they start in the schools and then they start doing it and then they change to something else. I can't really figure it out.
Yeah, so if you have kids, you probably don't get that, I guess. Just be happy I didn't write 6-7 on this report, because that makes me want to go to the top of the roof and jump off. Your kids do the 6-7 thing?
No,
Oh.
I don't know that one. I did.
Kids
Have you ever heard
around saying 6-7? Do you think it's something more material than that? It's not. It's just something there to. I guess it's. What do you call the Japanese suicide by honor? The seppuku or something. You know what I'm talking about?
Oh yeah, I know what you're talking about. Another word.
I heard. Math teachers nowadays, I guess, are just sort of like, if I hear 6-7 one more time, like self-immolate. Anyways, send your hate mail on that too, Jack.
But back on topic, like the sentiment thing. I was interested when you were putting up the previous sentiment slide, like what it was going to look like now. So here's kind of our look at what's going on now.
Yeah. So before in October, I showed you the 10-day change in our trail. This is the 3-day change in our trail. So earlier this week, pre kind of CoreWeave earnings, everyone is on the bottom right of the chart. What does that mean? Bottom right of the chart means people are pricing calls over puts. People are bulled up. What has happened in the course of 3 days? All of a sudden, it was like, I love my Google, AMD, Qs, Coinbase, Tesla. I'm in, right? To, oh no. And we are now bidding into puts. So the more on the left of this chart you see, we're more of a put bid, and then vol is picking up the more we go up. Now, the vols aren't really super expensive yet. This is based on last night's data, so today may be a little bit of a change there, but the point is the same, is that we had the state change, right? From like pretty bullish to like pretty bearish in the matter of just 2 days. You can see this, and this is the narrative breaking and falling apart. Now, all that said, like Tesla's down again, like 10% as an example. I haven't checked Google recently. It's not down, quite as much, but 10%, this is, if I was going to look at where this vol is positioned, that's not that bad. Like 10% in a day is kind of like you would expect vol to be higher, and you expect to be more of a bid to puts, right? Given that type of dynamic, and you look at like CoreWeave, which is down 20% or whatever, and the vol's just not really that high, which again speaks to this idea that there's more of a real money seller out there necessarily than a kind of a put driven spasm. On the same point, the GEX. So if you're familiar with positive and negative gamma, this line is the gamma by strike, right, across all expirations. And if you remove, so much of flow now is 0DT. So if you remove today's expiration, you get the dotted line. And what you see is we're negative across the board, right? So there's no positive gamma that offers stability or support in this market is the first thing to pay attention to. But the second one is, you see how the dotted line is just flat all the way to the right, all the way to the left? There's not an increase of put positions that are driving kind of like negative gamma to the downside. So a lot of times you would see this curve look like a ramp lower, right? And the idea is that as we move lower in the S&P 500, the convexity sort of picks up and the pressure builds right to the downside, and there's more hedging flows to the downside and all those kinds of things. And what's funny about that is when I look at that right now, I think there's just not that many put positions sitting there that are going to really drive things lower, right? Like because this line doesn't go materially down. So when I was talking earlier about not having a material downside level where I'm like, okay, this is where things should bottom, you kind of just look at where we're sitting right now, which is around 6560 to 6700, kind of under these strikes. And it's kind of quiet, right? There's just not this big bid to puts at the moment. And so you can look at that one of two ways. Number one is we don't have a lot of downside force from the options market past this point. The second one is, what if the Nvidia misses and things get worse and people are like, I got to buy some puts? Well, you have some room, right, to invoke downside from an already weak position, right? And that's where things could get nasty. In the worst scenario is if Nvidia misses and then suddenly you have like the credit default swaps jump of some of these companies. When the credit market starts to falter and you're owning Oracle bonds or something like that, well, the only way you could hedge out those Oracle bonds arguably is to buy Oracle puts, right? Because the equity would go to zero before the bond. So you buy Oracle puts, and that could be this price insensitive buyer of equity vol. And that's where things can get, that's where you start talking about, VIX 60 or whatever, right? Those types of scenarios. So that, again, I think to me highlights why this is so important around the Nvidia earnings. On this
people
point,
who aren't familiar with negative gamma, the idea is negative gamma means the options market has the tendency to maybe exacerbate moves in either direction versus dampening moves. Is that right?
Yeah, that's exactly right. So negative gamma means that when the market goes down 1%, we talk about delta in the beginning, right? Your deltas get more negative. What does that mean? It means dealers have to sell futures when the market goes down. Then they got to buy futures or buy stock when the market rallies, right? So they're driving volatility. A positive gamma market means you're doing the opposite. Market comes down. If I have positive gamma on my position or my portfolio, I'm buying stock into a weaker market. So you can imagine if I'm a big buyer, I'm supporting the market. I'm preventing volatility because I'm this big buyer that's sitting there that's buying into the weakness. So this is a negative gamma market, meaning market makers are going to sell when the market goes down. They're going to buy when the market goes up. And that exacerbates volatility. It drives volatility. If you think about that scatter plot of one-day forward vol, right? That we talked about earlier, just to make sure that's clear. This one, right? This is, negative gamma is in this environment, and the vol is bigger because their market makers are selling when the market goes down and they're buying when the market goes up, and it drives that volatility. A more positive gamma environment is this one right here, where they're buying the dip and selling the rip, right? They're buying stock when the market gets weak. They're selling it when it rallies, and that squashes vol.
And we would expect some of this negative gamma to clear a week from now when we have expiration.
Yeah, it's about, if you just look at take this as the delta representation, this is the single stock delta. But, from this, you would say about a third of all positions, right? Or maybe a quarter of all positions would expire. If you're looking at a gamma perspective, it's probably, a third to half of gamma would expire. Gamma's highs for at the money options as we close to expiration. So, depending on how you weight and exactly what we're looking at, we're moving a decent chunk. Whereas like in December, we're probably going to lose like half or maybe even more, right, of positions. So the argument is that if you have this negative gamma, right, then you would, if there was a huge expiration, then that dotted line, right, would shift materially higher, which is a signal that that negative gamma, that volatility driver has dissipated. The trick or the challenge here in forecasting that is if Nvidia earnings are good, market's going to rally and that negative gamma is going to start to burn off because there's going to be a lot of positions adjusting as the market rallies or sells off, right? So it's a little hard because of that big event to forecast exactly what this will look like into expiration itself.
My main job here is just to challenge your presentation skills and make you go 30 slides back and then come 30 slides forward.
Yeah, we bored everyone to death, and then we bored them all to death, and then we should make them sick by flipping the slide.
Exactly. So what do you get at this next slide with the tail simmering? Yeah,
tail simmering. This is the skew index, so it looks at I believe it's a 1 standard deviation spider put versus the at the money. And essentially what it just says is, what is the price of tail protection? And yeah, it's up, no doubt, over the last 1 to 2 weeks. But if you look at some of just big vol events from even just this year, mid-October, for example, it's hardly suggesting that there's this big bid into, out of the money puts basically in spiders, right? So, again, the thing of this is like, hey, Nvidia earnings are good. We'll smack that vol down. The SDEX probably goes back down to 60 and that's rally fuel, right? But you could easily say, Nvidia misses. And then there's plenty of space to this area where, there's this big bid that has formed, right? Like spider puts value spike, vol spike, and then you end up with the SDEX up in the 65 to 70 area as an example. So plenty of room to go up. It's not like we're in, if we were already here, for example, right, or here, then you go, look, nobody's going to buy an incremental put at this point, right? It's too expensive to buy options, which means that people are going to want to start selling those options just because the vol's gotten so expensive. But we're not really at that point. Like vol is a little bit rich, but it's not like a screaming, sell, so to speak. On that point, this is the VIX term structure. We just added this recently to the Spot Gamma platform. You can see last week, this is a pretty decent contango, meaning VIX and front month VIX futures are priced below. This is the normal situation. And then when you get this VIX curve, so first VIX future, second, third, etc., versus the VIX index, when you get this curve flattening out, right, that's the jumping point for vol, right? So this is flattening out. We're kind of in this stance again where it's sort of like the at the ready stance. And that's going to happen with Nvidia, right? Nvidia is going to trigger one or the other. We're going to collapse back to where we were, or what you get is backwardation where the VIX index spikes and then this curve looks like a ramp down, right? So again, it's hard to read this and say, hey, vol's too expensive, or hey, vol's obviously too cheap. It's really right in that middle spot where, this is where things break, but also there's a decent premium you could sell to help jack the market up. So, it's a weird, again, it's a weird situation.
Yeah, it's interesting when you see like an event like this. I mean, this really does, like, if we look behind the scenes, what's going on, it does seem like this Nvidia earnings is like a really major event in terms of where things will go, at least in the short term.
Yeah, and it ties to, I just think so much is happening, obviously, as we talked about credit market, et cetera. Here are vols. I show from 12/1, this is when the S&P, from 10/31, the S&P was near highs out of OPEX, and then from just a week ago, 11/7 versus today. And so you can see that, the 1 month skew, which we're looking at here, is pretty equal across the board. Now what we've done is we've shifted higher. The concern would be is if you saw this green line on the left side at put prices was much higher, which suggested there was a big bid into puts, right? So the put skew increase. But it's a parallel shift right now, which is simply saying that vol is moving, so all options are sort of repricing to more vol. It's not that we're suddenly bidding into puts, where there's a big concern. If you look at this, what's interesting, to give another example of this, is that if you see between 10/31 and 11/7, into 11/7, people really bid into calls, right? Because you can see that call skew, that gray line is peaked up here, right? Way around for these really kind of high calls, right around 7,200. And that call skew flattened out, right? So the similar thing here would be if we were expecting Armageddon like today, you would start to see this put tail, you would think, increase quite a bit, which it hasn't, at least yet. Nvidia miss, I think that thing goes very big, but we'll see. This is Tesla. Tesla was 430, 440 on Monday. Stock's now trading. It was 385 this morning. It's now at 404 as we open. But the thing that's interesting to me about this is that negative gamma bars below would infer put buyers. So that means a fund buys puts. There's clearly one big put buyer here at 350. But all these other strikes are positive gamma strikes. The way that this map generates positive gamma strikes is for hedge funds or retail to sell puts. So what's fascinating again to me about this, and this was as of this morning, if the story's over, then where are the put buyers, right? Like, where are the big put buyers for Tesla at like 310, 325, 350? Like, they're really not there. So if people knew that fundamentally Tesla was screwed, you would buy puts at some strike, right? And if anything, it looks like the way that people respond to this by selling puts, not huge, but small, which again speaks to this idea that people are just caught flat-footed, or it's the fundamental seller, right, that is driving a lot of the downside here. Because if anything, it looks sort of like the options market was positioned to buy a little bit down here, not necessarily sell. So this to me says, hey, we're not buying puts, we're not freaked out about more downside here, but it's also not huge positions, which again just brings me back to the idea like, well, why is the stock dropping 10%? Fundamental selling is one of those, kind of fill that would set in as an explanation there.
Yeah, as we get to the next slide, it goes to our point we've been talking about the whole time, which is everything's up to Nvidia. But also, like you could argue from a fundamental perspective, like forgetting about options, because sometimes options respond to stuff that maybe longer term investors, don't think that much about. But I mean, Nvidia is the center of the entire AI trade. Like if you want to, from a fundamental perspective, to figure out what's going on with AI, like I mean, most of these companies are working through Nvidia in one way or another. So this tells us when they do report it tells us a lot about what's going on fundamentally too, not just what's going on, not just how people are going to react on the options side.
Yeah, and so, look, I have no which way I don't know which way this goes, but if you're going to give me the outcome, good Nvidia earnings or bad, I think that the move that comes from that in the ensuing days will be big enough that you can just say, okay, is it good or bad, and then jump on board, right? And so I think I lay this out. Don't lay this out. So let me lay this out here. We have Nvidia earnings and VIX expiration, right? And so the argument here is that if Nvidia earnings are good, then suddenly these credit default swaps, the things that's getting so much attention there, that can cool off a little bit, right? Because then you can say, well, we can grow our way out of the, the debt that we're building or whatever it is. The story's still intact. So that confidence builds. At this point, you can say, hey, some of these stocks maybe are now cheaper because of the big sell-off recently. Also, vol is going to get sold off, right? That little bit of a bid to vol is going to get crushed, not just in index, but also in single stocks. And then you start to rally. And right now, S&P is, just to make sure I'm accurate here, 6750. So when you look at the open interest breakdown, there's a massive amount of open interest up at 7,000. It's this big magnet. Plus, it's a big round number. People like those big round numbers. So you're going to get the vol crush. But then what is the other thing, as we talked about before, Thanksgiving. Thanksgiving is this holiday where really that whole week is very quiet. People tend to not want to own vol over those periods, especially if vol is going to be a little bit rich, right, into this event. Plus, you're going to get rid of VIX expiration, which, assuming VIX is still elevated, you're clearing those positions out. So there's this like 3 or 4 items here that I can point to that say we're going to clear out the bad positions, the vol-inducing positions. We're going to give people an excuse to sell vol. Stocks are now maybe a little bit cheaper here than they were a couple weeks ago. If the Nvidia story is still intact, then there's plenty of room for a pretty serious bounce here. And again, because of the holiday, you just go, all right, Thanksgiving's done. I know what the deal is with Nvidia. Then the next thing I got to worry about is FOMC, which is on, mid-December or something. And that's going to feel like a lifetime compared to where we are right now and heading into Thanksgiving, right? So that is the idea of, I think 7,000 could come pretty quickly, and that is the upside target if Nvidia is all right. The second one is obviously if they miss, and that sort of cauterizes or drives home this idea that the AI story is in serious trouble. And the problem there then is that I think then you have these issues like these credit default swaps, and CapEx, the spending that has driven the GDP to be positive, all that stuff starts to come under question in a major way. And then people can start going, look, what's the growth story in the United States, just period? And the Mag 7s are 35% of of the S&P and the NASDAQ based on this story. And then you start to go, uh-oh. And then I talked about the incremental put buyers, or the put buyers who are price agnostic because they're hedging out, bond exposure, credit exposure. You could get into the situation, you can write this script where it's a pretty ugly scenario. And if it's a pretty ugly scenario, then there's no material shift in positions until December expiration, right? Because that's such a big expiration. But then the other question I have is, what data point on the AI side may you get that could change the narrative, right? Avgo, I think, reports in mid to early December, but it's not like there's this event where you can point to and be like, hey, here, this can change the AI story. It's like, there's not this obvious data point that we can all ratchet onto or hold on to. Now, maybe you can make the argument that FOMC, if the market's down, say 5%, FOMC will cut rates then, and that could bottom things out. But the point is that with the bad Nvidia earnings, then there's not a reason suddenly that vols that's just a little bit elevated feels cheap. We talk about that SDEX going to 65 or the VIX going materially higher to like 70 or 30 or 40 or whatever. Like those scenarios come quickly into play, right? So that's the problem. And the thing is like normally I have a level where this is where this thing exhausts, but I don't see that level right now. I don't really have it. The level of downside that you'd be like, okay, let's think about maybe buying this dip is, where would vol get expensive, right? Where do you start to see, VIX 30-40? Where do you start to see call skew or put skew, in the 90th percentile? Those kinds of trades, right? And so it's more of a vol-based bottom we'd be looking for as opposed to a price. 6,500, 6,250, that stuff all feels like it could be pretty quick and easy in that type of a scenario.
Yeah, this next chart is cool. I mean, I can't say I know what it is, but I'm a sucker for a good heat map. This is a high quality heat map here.
Yeah, thank you. I just built this, and I just kind of was finishing it up. So take this with a little bit of a grain of salt. And the number one point here was to depict how Vanna as a driver of flows is important. And so what this is we look at our hedge fund positioning, and then I took the opposite side of that. And the reason I took the opposite side of it is because I want to show you what the dealer exposure is to this, right? So the red here is basically saying that deltas are negative. What does that mean? This tells you that if the market rallies, right, and vol comes in other words, IV comes down in the S&P 500, there's negative delta exposure for the dealers. What does that mean? Well, how do you hedge out negative deltas, Jack? You buy stock, right? You have to get that exposure to be zero. So in this situation, what is interesting is to the upside, if vol contracts, this suggests that there is buying that has to take place from market makers basically up into this 7,000 area. Does that make sense? In other words, this red exposure has to be isolated with new stock purchases. In here, right, there was a small path of selling in and around into 6,500 where if vol increases, right, then you have to offset positive delta exposure, which would be selling futures. Does that make sense?
Yes.
Now that seems to putter out or sputter out here at 6,500. So this chart almost infers that this idea that we kind of moved to 6,600 this morning, and then under the 6,500 level, maybe that vol doesn't really drive more dealer hedging flows from a vol perspective. And this ties back to the fact that when you look under where we're currently trading, there's no real big put positions. If there was giant put positions, right, then the fear would be that if the market goes down, right, then the dealers have hedging exposure that they have to sell into, right? In other words, you would think that the map would be a little bit more blue there, that exposure would be, more negative, but at the moment it's not. So the point here is that this attempts to put some dollar values around, how much could change, and you're talking about 10 or 20 billion dollars worth of delta flows, right? That would have to be adjusted when vol shifts up or down 1 or 2 vol points. So that can be pretty material, right? Particularly if vol continues to contract over positive positive Nvidia earnings, et cetera. So this is a chart that we're going to start to offer on our site. I'll start putting in our founders notes with a little more frequency. But the point here again is to establish the impact of vols a little bit, and I think this is kind of the first time I've seen again some values put to those flows.
Yeah. So in the last two here, we're getting this idea that there's a right tail and there's also a left tail.
Yeah, and so this is a new calculator. We just launched this with our Hidden Forces launch. That was the end of the month, and this allows you to adjust skews. And so what I did here is I put in a call fly. I think this is kind of an interesting trade to play a rally, and you have to adjust for this because the market's moved a lot. But the idea here is I want to try to get a fairly dollar-neutral trade. So if you sold a 6,700 call and then bought two 6,800 calls for December expiration, that gives you a real nice bid if this market does rally and we move up into the 7,000 area, particularly if this happens over into the end of November, right? Because vol should, start to come down a little bit. So what I like about this structure here is that it isolates you from a vol contraction. But if we do get this really big kind of 3 or 4% rally, then this structure should do pretty well into the face of pretty limited downside, right? So, you can see the payout here. The max loss on this trade is about $3,000. Max profit is about 15 grand. You can adjust this to get a little bit of a better risk reward there too. But I like this kind of, we call this a 1/2 ratio spread to play this upside. This is better in my view than just buying an outright call because number one, the calls are fairly expensive because implied vol is so high. And if implied vol comes down after the Nvidia event, that's a tax on your call, right? So this is an attempt to sort of remove some of that impact while still getting a lot of nice upside exposure. And this works if you do get that really big move. If it's a kind of a sleepy 1% rally, this structure won't work out quite as well. And then to the downside, the problem here with buying puts is this. The vol is expensive. And so this dash line is what the current market implied vol is, right? And what this basically says is if the market goes down to 64.50-ish, right, which is what this put is, the 64.50 put for December expiration, the market goes down to 64.50, the projection is you make $3,000. But when we adjust skew a little bit and just say, well, what happens if the market vol comes in, you can see that P&L very quickly goes from positive to negative, right? And this is just saying, what happens if vol just goes down to where it was 2 days ago? So not a giant vol crush. So the problem with buying puts here is that if the market just settles down at all, right, then vol immediately starts to contract, and then suddenly anyone who owns puts is feeling the pain, and that speaks to this idea of Vanna as a flow, right, as bidding the market back up. So if you have to hedge something, that's great. If you're just buying puts on a speculative view, look at put spreads because you can offset some of that vol risk a little bit, but just be aware of this dynamic, right? The puts are expensive on a relative basis. They could obviously get way more expensive if Nvidia misses, but you have to be prepared to pay a tax right now, and the tax is pretty high. If Nvidia is just kind of flat to no big deal, then vol should come down, and those puts are gonna weigh on you. Also, with the Thanksgiving period coming up, there's a lot of time decay in these puts. So you need Nvidia to miss, and you need a really nasty reaction in order for these puts to pay off. Which could happen. It's just you have to be aware that that feels like a little bit of an uphill battle at this moment. Because when does Nvidia ever miss, Jack?
Yeah, hopefully not now for all of our sakes, I guess. So I guess, Brent, the viewers got a wide variety of things from us today. They got us talking about politics without trying to talk about politics to limit the hate comments. They got some macro takes. They got a little value investing from me. We definitely got a lot of options analysis, and we also know that it is cool to say bro.
And don't look into the 6-7 thing. Avoid that one. So it was a lot of fun, Jack, and I think this month's view were quite a bit different. Normally there's options as the big driver of things. Here, it seemed like a little bit different, but hopefully we gave a couple ideas in the options market of ways to express some trades and some views out of this thing. So a little bit of a different take, but we'll be back in December where we'll have the biggest expiration ever, so we can re-solidify options at the biggest flow in the world.
Yeah, and I really enjoyed doing this with you, bro. I got to try to use it. It's not that well there, but I got to start working it in now.
I like it.
Cool. So
I like it.
Thank you everybody for joining us. We'll see you next time.
Thank you for tuning into this episode. If you found this discussion interesting and valuable, please subscribe on your favorite audio platform or on YouTube. You can also follow all the podcasts in the Excess Returns Network at excessreturnspod.com. If you have any feedback or questions, you can contact us at excessreturnspod@gmail.com.
No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of the firms of the hosts or their clients.